Hello, welcome to this webinar on our latest acquisition. This is called Lenexa Plaza. It's a neighborhood strip center here in Kansas City, where our headquarters is, and very excited to share with you about this property. This is actually the fifth strip center that we've purchased over the past year, with all others performing at or above expectations and projections. And just really excited about this asset class for a lot of reasons. So very excited to get into this webinar. And as always, this was recorded. So if you have questions, please do reach out to our investor relations team. You can always schedule a call at your convenience. It should be linked there at the bottom in the data room. And anything that you need at all, just feel free to reach out to us. All right. With that, got to give the disclaimer. This is not an offer or solicitation to buy any security. You need to review the full private placement memorandum presented to you to understand all the risk factors and projections, et cetera. I will make forward-looking statements or projections, but past performance is not necessarily indicative of future performance. So with that, let's jump right in. And for the purposes of this webinar, I'm not going to dive a whole lot into the backstory of Aspen. You probably have learned a little bit about our team, a little bit about our background. And if you've watched the Opportunity Fund webinar, you can get a little more insight there. But these are two co-founders, Bob Frazier, James Fuccio, started Aspen over 11 years ago, and have really scaled it into one of the fastest growing companies in the U.S. And really by serving our investors with great risk-adjusted returns and investments that we're providing. And really our whole approach is from the beginning been opportunistic, looking for the best opportunities given the current economic environment, and then putting our own investment capital behind those investments. The other two partners here are Dan Schulte, who's our COO. He's an attorney and former CPA, was general counsel for a large publicly traded mutual fund company before joining private equity and coming on board with Aspen about 6 years ago. Then myself, I'm the chief investment officer, responsible for vetting, sourcing, and putting together all of our deals that we do and put out for our investors. And just like I already mentioned, our process is very different than a lot of other operators in that we're really looking at scanning the landscape of the investment world, looking for the best risk-adjusted returns. And what we want to do is not just pick one asset class and just be a hammer and everything's a nail. We want to look at where are the best opportunities, even if it's a little bit contrarian to what the herd is doing. We want to be able to identify those and look at the big trends that are supporting these long-term theses. Then we look for the best strategies and the best asset classes that are going to benefit from those trends. And then we put together best-in-class teams, partnerships, and investor-friendly structures. And then ultimately we invest in every single deal alongside of our investors for really the ideal alignment of interest that you want to see in your operating partner. Here's a track record. Actually approaching $200 million in investor capital managed, been on the Inc. 5000 for several years in a row. Been around for almost 11 years now, and have sent our already since inception $50 million in distributions back to investors, which is our favorite stat. We have a really broad set of experiences, and if I walked through the background of every single one of our principals, it would be you'd be surprised to see the breadth of experience that we've had. From a commercial banking background and private equity background. Dan comes from a private equity background and securities background as an attorney. Bob ran a hedge fund and in private real estate, and Jim has been in development and in real estate for over 30 years. So we have this really broad set of backgrounds that really give us a unique perspective in how we are evaluating and putting together portfolios and investments across the board. Lastly, if you're not already subscribed to our podcast, you're missing out. This is really fun. We actually just cracked in the top 1.5% globally, thanks to our amazing listeners and folks that are just following along here for this fun ride. Our real goal here is just to educate investors around alternative investments. And so this is something that will just help level up your game in investing in alternatives. Okay, let's get right into the deal itself. So the big idea, right? This is our fifth neighborhood strip center acquisition in Kansas City, like I've already said, in the past year. And so if you've seen us present these before, a little bit, this is going to be a repeat, but that's okay because the thesis is intact. The thesis is we're proving it out right now. It's working really, really well on the other acquisitions that we've had. And it's something that actually continues to get really incredible headlines on recent news articles I'm going to share here, and continues to kind of be the little shining star, the kind of hidden gem in the midst of commercial real estate that is, different parts very challenging right now, especially office and in some sectors of multifamily in different markets. And so this continues to be a shining star. I'm going to share with you why we're so excited about this and what's working so well in the other acquisitions that we've purchased. So first off, we're targeting neighborhood retail strip centers, right? These are the strip centers that are in near neighborhoods. These are not the big box retailers. These are not shopping malls. These are the small strip centers in really nice areas by uh, neighborhoods, and these are places that people stop by the way home. This has your dog room. This has your liquor store. This has the dentist. This has a phone service shop, all the different things that really can't be e-commerce because they're services or their product basis you need to interact with someone on, like a phone. Um, and generally across the retail landscape, these have highest rent growth, lowest vacancy. They're located right in the heart of neighborhoods. They're service-oriented tenants. And so just a really, really great little niche. And what's been so interesting as we've kind of seen in some of the articles that are coming out about this asset class, part of the reason why it's been so successful is as it kind of the post-COVID world, as employees and individuals are at home more than they used to be, right? They're working from home more. They have a hybrid flex schedule. They're fully remote. They're closer to these strip centers. So it's just the convenience factor. They're frequenting these a lot more. And that's really driven a lot of demand to these types of properties. Some of my favorite quotes from Warren Buffett are just kind of being a contrarian investor, right? Be fearful when others are greedy and greedy when others are fearful. What the wise do in the beginning, fools do at the end. Right? This is the idea where, as investors, we all want to say that we're contrarian or that we're value oriented or that we're willing to look and jump into areas that are different than the herd. But it's difficult to do that, right? And sometimes you don't want to do that because it doesn't actually make sense and it is a false positive. But all the trends that I'm going to share with you are pointing that this is not the case. So, what are some of the reasons you want to invest? Why is this so interesting? Well, one of the kind of core reasons we love this asset class is you have positive leverage day one. What does that mean? The unlevered yield that we're purchasing these properties at is higher than the debt costs that we have to pay, the interest costs to our lender. In most other asset classes right now, that is not the case. And when that's not the case, buyers are taking a risk that they can stabilize a property much higher than their debt service costs, or they're making a bet that that interest cost will come down. Either one, it's riskier than when you're in day one coming in with a positive leverage, and not only positive leverage, but these are value adds. So we actually expect to stabilize the yield on these properties in a 13 to 14% range, right? And our debt costs are going to be should be in the sixes. That's kind of what we're seeing right now. We can get those fixed for several years, and so we're looking to put really nice debt on this to be in a really great position from a leverage standpoint. Other cool thing is we're actually buying this property. This is in Johnson County, which is the best submarket in Kansas City. And other recent comps have sold anywhere between 140 and 160 dollars per square foot. We're buying this at around $92 per square foot basis because this is a mom and pop owner. It needs a little bit of love, needs some TLC, needs just some aesthetics to kind of improve the curb appeal, and they don't have the capital to do that. They're ready to be done, and they're selling it at a really great basis. So that is the recipe for a good, going in project to go and really capitalize on the great opportunity we have here. So strong cash flow. We're expected to be producing 8 to 9% cash on cash yield on an average basis over the life project. That's going to be growing over time. That's the average on our first project, two property portfolio. We're actually already distributing about an 8.5% yield, not even a year into the project. On that portfolio, and it's going to continue to grow as we get these lease turns and more occupancy. So cash flow, if you like cash flow as an investor, you gotta love it. This is a great place to be. very fragmented industry. It's very minimal institutional ownership, lots of mom and pop owners. There's a lot of inefficiencies we can capitalize on. Strong sponsorship team. This is, we've been doing this for a while, and our sponsorship team has extensive experience in this asset class, the same type of property. Literally, one of the other properties in the four that we've already purchased is across the street from this property. I'm going to talk about why that's going to create some great economies of scale for this project. Sponsorship team is standing behind the property. They're guaranteeing the debt. We're going to be co-investing as LPs right alongside all of our investors on this property. We're going to have great, attractive sort of debt terms and obviously tax benefits. We're going to get some nice year-one tax write-off for the cost segregation, bonus depreciation. It's a little bit lower leverage. We're seeing about 60 to 65%. So it's not going to be maybe about 40-50% of capital invested in kind of a year-one write-off. So if you invest $100,000, expect $40,000 to $50,000 in tax write-offs in the first year. So here's a picture of the property you can see in the lower left-hand corner. Literally to the left of this street, which is a main frontage road, this is Quivira, is our other property that we already own, and that's doing very well. And so this is the property. You can see it's the parking lots need to be resurfaced. The roofs are in great condition. A lot of the bones are just really, really good. It's just the visibility. They've actually done a terrible job here. You can see the trees. These are, if you look from the road, you can't even see into the strip center because these trees are, cleared all the way, or they have brush all the way down to the ground. So a really simple thing is we're just going to clear the bottom of these trees, just lift it up the kind of base level of the visibility so you can see right through, or really, make the landscape look a lot nicer. We're going to increase better signage. We're going to just do some basic kind of work to kind of push out the visibility of the signs for all the tenants. Lots of really basic stuff we've been doing at the other properties that are just really working out well. So just from the structure standpoint, we are targeting a $50,000 minimum investment, a 8% yield, preferred return. Projected hold period is 5 years. Annual return, we're expecting is 15 to 20% annual return. IRR, 15 to 16%. Cash on cash, 8 to 9, right? So we're not betting a huge amount of that or total return to come from the back end and the big cap rate reversion or compression, excuse me. We're going to be, paying out nice cash flow right along the way. We're targeting kind of that 1.9 to 2x equity multiple over that 5-year period. We have 2 waterfalls. So if you are like this project, like this type of an investment, we have an investment at $250,000 minimum, and you get better returns than what's shown here. This is shown for the $50,000 share class. Okay, so we're just going to go kind of through some high-level market data. Why does retail make sense? And then we actually have a supplemental section of this presentation you can download and look at more. We've spent a lot of time on this in our podcasts and other presentations, and it can really take a lot of time to go through, but you'll see all the data that supports our thesis here. So a lot of the first question is, well, retail apocalypse, right? E-commerce is making retail irrelevant. What we've seen here is that e-commerce has been flattening. The penetration here has been flattening over the past few years. And there's actually been a resurgence back to brick and mortar. And we're seeing a lot of big retail companies focus on what's called omni-channel, right? They want not just the digital, but they also want the physical. Like Amazon is a great example. They bought Whole Foods to be that brick and mortar kind of central location to be able to do a lot of different things. And it creates a lot of efficiencies to have both, right? You can't do in certain businesses, 100% just digital. You got to have some of the brick and mortar. And so despite the e-commerce, 86% of all retail sales are still in brick and mortar, right? So it's still the majority by a long shot of where retail is purchased. And it supports a lot of jobs. Online shopping is still going to be happening, and maybe penetration continues to increase, but it's definitely flattening, slowing down. We're actually seeing kind of that reversion going back more to brick and mortar stores. These are the articles that I was mentioning. This just came out literally a few weeks ago, and the Wall Street Journal on the front page, the hottest real estate plays in your neighborhood. What? This is crazy, right? And neighborhood strip centers we've been talking about for the past year and a half. And these, unglamorous retail centers are signing leases faster than tenants can move in. The vacancy rate is very, very low. Rent growth is very high. You can see here on the occupancy. It just continues to climb in this little sector, and it hasn't really dented, the boost online shopping, all this e-commerce hasn't really dented bricks and mortar because the demand is really intact because a lot of the types of tenants that go to these strip centers are service based. They're very low e-commerce threat, and it's right by people's homes. Like I was saying earlier, this is not you have to go drive downtown. You don't have to go drive to a shopping mall. These are right on the way home. You're picking up things. You're doing things for your pets, for your physician or whatever. These are the types of services that are not being replaced online. Here's the other really like big factor here why this is a great place we want to be in is these properties are trading below replacement cost. There's very, very little retail strip new construction coming online simply because the replacement cost to build these is so much more than what they're trading at right now, right? And that's just basic, economics 101 of that inefficiency is going to is going to shrink over time because as people realize, wow, I can buy this for way cheaper than I can build, and there's not a lot of supply coming on, which is going to continue to exacerbate that supply demand inefficiency. It's going to continue to push values up on these types of properties because as the occupancy goes up, as more demand comes in, but there's no more supply, right? There's a fixed supply. You're not building any more of these, or not very many of them. You can see here over the past decade, it's just been very, very little relative to the kind of mean since kind of the pre-08 timeframe. It continues to just trade at this very low level of new construction. Again, this is all more retail sales. I'm not going to go into this. You can look at this here, but retail sales are climbing. So on an overall basis, a lot of people are concerned, well, there's a recession coming and the consumers is not a really good place. We've been talking about this for a while. The consumer is actually very, very healthy right now. And, there's certain trends that are, like savings rate is declining, but that's the rate of savings. It's not just pure savings. There's still excess savings of 30% above pre-COVID levels right now of consumers, and they continue to drive a lot of retail sales growth. And we expect that to continue, right? That retail sales are going to continue to be strong for a little while here. NOI rent growth and vacancy, too, like we've already talked about. When you have limited supply, when you have strong demand, that is driving down vacancy, driving up occupancy. And what does that do, right? Simple economics 101. That's going to drive up prices on the leases. And we're seeing this across the board in all of our other properties. Literally one of our properties, it was 100% leased. All these leases were not triple net leases, and we are converting them as they turn over to triple net, which is more expensive to the tenant, and we're increasing the base rate. And we've had almost 100% renewal rate. There's only one person that said no, but they're actually shutting their business down. So it wasn't really a non-renewal. It was just, or was it because of the pricing that they didn't renew? And so we're seeing this case. There's just not a lot of other options, right? If you want to be in these kind of neighborhood areas and you're a restaurant or you're a dog room or these other things, that's where you want to be. And there's not a whole lot of options. And so we're continuing to see this is the projection for vacancy rates to continue to go down. This is the projection for rents to continue just to trend upward. This is in Johnson County and Kansas City. You can see there. So let's talk about this particular asset. This is overlooked asset class. Less than 5% of these strip centers are owned by institutions. So it results in unsophisticated ownership, a lot of inefficiencies, a lot of value add, which we're going to get to here of how we do that. Already talked about what these are not. We're not talking about the massive malls. We're not talking about the big power centers, which are struggling. We're not even talking about grocery anchor centers, which have performed well, but they're highly dependent on the grocery store tenants. And you're generally going to buy those at much lower cap rates because of these kind of bigger grocery anchor tenants. They're a little farther from our homes. These strip centers are right by our homes. You can see here, this is the neighborhood center and the strip center. The two things we're looking at here have the really the lowest vacancy, and we've seen really some of the lowest e-commerce exposure as well across them. These are usually less than a mile from our home, whereas the growth rate of the power centers are much farther. So it plays onto that theme of these are, for people that are working from home, working remote, working hybrid, these are going to benefit from that trend. I mentioned this before, the omni-channel. This is where a lot of retailers are kind of looking at the whole picture of how retail is being purchased, and not just the online experience, but the in-person experience. They're actually seeing a whole new trend of these big companies opening new stores, right? They're actually opening new stores. So it's going the opposite of what a lot of people think. So this is a value add. It's really actually pretty simple relative to other types of projects you've seen. Really what we're doing is you know, uh, we're looking for properties that have very low rents relative to the market. And this is a great case of that. We're about 20 to 30% below market. And what we're going to do is just going to work through these leases as they come due, negotiate with our tenants and get them back up to a market rate. And, then what we're going to do is we're going to renovate the property, increase the visibility, improve the signage, improve just the overall curb appeal of this property. Because as we drive more traffic to the center, then that's going to increase the demand for the tenants. And again, this is right on main frontage road, right across the street from one of our other properties. And then we can really you start to raise the value of this over time as we increase occupancy, increase overall lease rates, and improve the curb appeal of the property. Kansas City, this is, if you're not familiar with Kansas City, it is such a great market, very diverse economy, continue to have strong population growth. It's a great, very strong, big MSA, over 2 million people, and continues to perform very well. It actually leads, it's one of in the top um, uh, metros here for rent growth in the country. Here you can see Kansas City, a year-over-year rent growth. So what's the business plan? This property is in a dense suburban location, so we can continue to just kind of push that rent growth. It's in a very affluent area. So Johnson County is the strongest submarket in the city here. Very strong population growth trends. It's actually really close to two other properties. So the one right here is across the street. The other one is right over here. It's only about 5 minutes away. Not that far at all. So we're going to add value by increasing the rents, reconfiguring spaces, trying to attract larger regional and national tenants, doing minor capex. It's currently being owned by, managed by the current ownership group, very, small leasing team, and they just don't have the pulse in the market. So this is where we can really come in. It's currently 82% occupied. So we plan on increasing the occupancy as we improve the curb appeal. But to be conservative, we actually underwritten a stabilized vacancy of 12%. So assuming that we only get to 88%, and we don't actually lease up the whole property, and the returns that we're showing are based on that stabilized vacancy. So it's pretty conservative in our underwriting. You can see just kind of what the front looks like, right? It's a little outdated, kind of this old ugly blue. Signage is pretty bad. So a lot of things we can do is kind of bump this out, make it look a little bit nicer, just improve the visibility, improve just the signage for the tenants. You have a nice little diverse mix of tenants. We got management companies, some retail, some food service, arts and rec, and healthcare. So there's, I think, one modified gross lease, but most of them are triple net leases, which is actually great because the tenants are already used to paying, the common area maintenance, the property taxes and insurance, and they're used to having those charges being pushed through. So now we can convert them to more market rate and true triple net, where some of them are a little bit modified as we kind of improve the capital, or improve the property through a CapEx program, improve the visual appearance of the shopping center. We're going to get our professional leasing strategy in place, bring these to where we think is the market is 16 to 18% or $18 a square foot on a triple net basis, which we're seeing in the submarket across the board. And we can even use the kind of economies of scale because we have this property across the street of, we can kind of mix and match. And as we're kind of marketing both these properties, we're going to have a broader appeal to different types of tenants. It can provide more options for these tenants. So here's a little mix, or you can see the map here of where our property is. This is what we're talking about right now. This is the one we already own, literally across the street. And then just actually only 7 minutes, but 1.4 miles away, not that far, along Tomahawk Creek, which is right over here. So we get some economies of scale from uh, purchasing nearby property. So we can optimize costs, we can share resources with maintenance, security, marketing. So we're going to potentially decrease some of our operating expenses. We can get better tenant diversification. So we're not really competing for tenants. We're actually, we can actually work in our tenants' favor to help them get the best area for them and give a very diverse mix and option set of what they can use to kind of come in. Um, and so we're currently renovating the Quivira Square, which is across the street. We significantly increased the rental income, and we have a CID in place. And so this property is going very, very well. And we can, ride the coattails of that property with this one. So here's an example. This is another property I went over in Grandview. This is what it looked like before, right? Very sleepy, not great signage. Parking lot was in disrepair. Just the landscaping here doesn't look nice. Here's what was done. Improve the signage, just some fresh paint, resurface parking lots, got some better tenants in place, and just really improve the value of this uh, this property. So why are these so great? We love these. You get high occupancy. We're going to continue to drive that, to 90% plus. Great location. Got a great traffic count on one of the main frontage roads there, Quivira. A lot of development nearby. We're converting these leases to triple net leases. We're implementing professional leasing and management, attracting larger credit tenants. Here's some of the developments going on in the area in Lenexa. So we have Lenexa City Center, which is just a really big kind of mix of shopping, of restaurants, entertainment, office, living spaces, hotels, and just a few minutes away. So that's really bringing a lot of attention and just population growth to the area. Then we have some brand new, really nice, big properties that are just bringing more residential demand and to this area. So here's some of the metrics here. I'm not going to go through all these, or I hit some of these, but some of the things that I think are just really, really important to see here is year one going in cap rate is 8.12%. Year three cap rate, we're stabilized at over 13%. This is, you're not seeing yields like this in really any other real estate asset class. We're going to be averaging a 1.9 debt service coverage ratio. So from a risk mitigation standpoint, there's a lot of cash flow to protect against the downside of this project. One of my other favorite metrics here is our WALT, our weighted average lease term, 1.6 years. And that is the average lease term that our tenants have remained on their leases. And so that allows the shorter that number is, the smaller that number is, the faster we can turn these properties to market rents and improve the cash flow and operating income statement of this property. So 2 ways to invest. You have probably seen the Opportunity Fund. This is in the Opportunity Fund data room. And so this fund is investing in this property. What we're doing, we're allowing for certain investors that don't want to invest through the fund, they can invest directly into the syndication. So the difference is, the fund will be getting better economics because of the pool of resources. So if you invest through the fund, you will be investing at preferred terms through the fund, and you also get a diversification through the other assets in the fund. So, for a lot of investors, this makes a lot of sense. But for those that just want to kind of pick one off, I just want exposure to just this property. We're allowing that through a direct syndication. And so it's really, choose your own adventure. It's really whatever you prefer. We want to have maximum flexibility. So we're allowing both of these options for you to invest in to the property. And we hope you'll join us with this. This is, because it's a single property, it's a smaller raise. We expect it to get filled up very fast. And so we encourage you to submit a soft commit on this data room in the form below, and let us know quickly if you want in, whether you want direct, you want to be in the fund, and we'll get your name on the list. But we expect this to go very quickly, given this is our fifth one. All those are performing well, right across the street, and it's a single property, so it's a little bit smaller equity raise. So with that, I hope you enjoy. We got, here's some ways you can reach out to us, investor relations at aspenfunds.us. You can call our number here, 800-940-1510. And we're going to be closing on this first week of November. So we're taking kind of the final capital in the door the last week of October. So that's the timing on this property. And hope you will join us in in this exciting investment. We appreciate you watching this webinar. Thank you.